we have recently released our latest credit quarterly outlook, titled "This time is not different." The title refers to the fact that the consensus view has shifted from a recession scenario to a soft landing scenario. We believe markets are too optimistic and too complacent. After all, we've experienced the most aggressive hiking cycle by central banks over the past 40 years. And historically, significant monetary tightening cycles have always resulted in a recession. We still believe in that economic law. The only thing that is different is that the time lag of monetary tightening is longer than usual. And this is caused by special factors after the COVID pandemic, like catch-up demand for services, consumers' excess savings, and outsized fiscal stimulus. However, these special factors that have supported economic growth have now largely played out and will no longer boost the economy going forward. It is good to stress that we don't expect a deep recession, as there has not been a capex boom, and the labor market has been very resilient. So all in all, we think that a soft landing scenario seems a bit too optimistic, while a deep recession scenario seems a bit too pessimistic. Looking at valuations, fixed income as an asset class is very compelling given current yield levels. Looking at valuations from a credit spread perspective, there are differences across regions and ratings. For instance, high yield spreads are relatively tight and have not priced in a deteriorating economic outlook. Also, higher interest rates will soon start to bite the lower rated companies as refinancing needs are increasing. And as such, we expect credit spreads to decompress and expect lower quality high yield to underperform. And therefore, we think now more than ever, it is important to run a strong quality tilt in high yield. Within investment grade, we still see many pockets of value, which offer better rewards given the risks. We prefer quality carry, such as high-rated corporate bonds, European banks, agencies, and covered bonds. We believe that both from a strategic and tactical perspective, it makes sense to consider a short maturity credit solution in a fixed income portfolio. And by short maturity credits, I mean investment-grade corporate bonds with a maturity up to 5 years. From a strategic point of view, shorter dated credits offer a better risk return than longer dated credits. And historically, through the cycle, credit returns of shorter dated credits have been pretty comparable to longer dated credits, as shown on the y-axis. However, there is a big difference in terms of risk. As shown on the x-axis, shorter dated credits have offered significantly lower volatility than longer dated credits. And that has to do with the fact that shorter dated credits are less sensitive to moves in interest rates and hence behave less volatile. Obviously, investors are always looking for the most attractive investments from a risk-return perspective. Well, short maturity credits fit in that philosophy, and it could provide diversification benefits to the overall fixed income portfolio. Secondly, from a tactical point of view, we think shorter dated credits are very compelling in the current market environment. Yields are at the highest level in over a decade, while yield curves across the globe are strongly inverted. And this means that yields on shorter dated bonds are higher than yields on longer dated bonds. So this provides a unique opportunity for investors to benefit from the higher interest rate environment without taking too much duration risk. So shorter dated credits are not only attractive from a strategic asset allocation perspective, but are now more attractive than ever given the current market environment. Following the sharp rise in interest rates over the past 2 years, many investors have bought into money market funds or local government bonds, which makes sense given attractive yield levels. However, we are approaching the end of the hiking cycle, and research shows that historically, over various investment horizons, short maturity credits have outperformed money market funds after the final rate hike. Also, from a current yield perspective, for a euro investor, yields on short maturity credit solutions offer a pickup versus 2-year German Bunds and Italian BTPs. So I would advocate to shift a part of the money market or local government bond exposure to a short maturity credit solution to benefit from higher yields. And on top of it, it also diversifies risks within the portfolio. We invest in more than 100 high-quality different issuers, while if you would invest in a government bond, it would be only one issuer.